you guys enjoyed the long weekend. We flew the flag proudly, and it was a great weekend here in Denver. Hope it was where you were. This, by the way, has delayed our intent to return to the mountains. We plan to go up to Steamboat. Haven't been there in a couple of months. Tomorrow, uh, now I've got to hang around and yeah, I can that or drive with one eye, and that's that's a chancy road as it is. So anyway, okay, we're recording. I'm Tim Quast. This is the Edge demo for June 1st. It's June already, hard to believe. I always get just a little bit melancholy when I know that we're only 20-ish days out from the time when the days start to get shorter again. I love the long days. It's great to get out on the bikes early. We can be out at 5:45 in the morning. Anyway, it's good to see everybody. So, Tim, I was starting to say this, that we had the plan that I want to cover today is how do we know a shift is occurring? How do you know that there's one coming in the data? Are there good signals that you can depend on? How do you know in specific stocks? I mean, how do we know that the tech or the AI or the semiconductors, Barry Norton, have been very favorable? How do you know a shift is coming? Is there a way to see that in the data? What if you don't want to trade short term? That is the sweet spot for Edge, but is not the only use by any stretch. There are ways that you could just build a portfolio that you periodically balance back to the things that you want, and you're very likely with the math to do better than the market. Which it's really interesting to look at the data. It's what I do all the time to see that. And here I'll share. Did I share my screen? I have not yet, have I? To see how concentrated the market has been. You take out 7 stocks and the S&P 500 is down. If you look at the performance by sector, it is heavily concentrated in the 10 largest stocks in each sector. It's part of the reason why when we build a portfolio like the momentum or low volatility portfolios, that we concentrate on liquid larger stocks, because that's where the money's going. And just kind of across the board, the largest stocks are the ones that are outperforming. And that bucks a very long-term trends of how you would benefit from growth stocks. So anyway, that's it. It is what it is. When can you chase price, and when should you not? For those you veterans, we talk about using volatility as an entry point. For instance, well, I don't want to get ahead of myself. I will talk about that. That's the fourth thing, and then finally, what's ahead? Jobs data tomorrow. We'll have options expirations mid-month, index rebalances. Are index weightings way out of whack? Probably. It doesn't necessarily mean that people change them, but I think it'll be important to see how the data shape up into June options expirations, and that'll be right in line with the Fed decision, which now everybody's adopting the term skip. That there's a rate skip. I'll tell you, it's an amusing thing to watch all the economic and monetary policy circus participants. Okay, so that's the plan. So getting right into it, let me just make sure. And again, the rules here, if you're new, there are only 2. Mute yourself while we're having the discussion and ask questions. And you guys have been really terrific about this. By the way, we have this content partnership with Interactive Brokers, and I may have described this to you before. It has been like pulling a molar with pliers. I will have a presentation for IB customers next week on the 7th. The first thing, it's been a year-long process, and we're finally getting some machinery in place to begin to get in front of their 2 million customers, but we haven't to this point. There are lots of other things, but that has been a long process. So I'll keep you apprised of that, and I'll share it. I can share, this will be the basics for these folks, where I'll go back to some of the market mechanics and supply and demand and why you trade supply and demand and not price. So that's what I'm going to talk about. But anyway, I just it crosses my mind to mention that. Okay, let me have just a quick look here to make sure I don't have anything immediate. Okay. That's all great to me. Okay, let's see. All right, so let me get started here with this. How do we know a shift is coming? And there are, to me, a very important set of things. There was a checklist to always look at to know when something is likely to occur. I always start right off the bat with broad sentiment. We've had a great run here from May options expirations where demand was rising and supply had really fallen. Well, those are the conditions that are very likely to give us gains. Overall, I mean, it's been highly concentrated in certain parts of the market. Clearly, tech, communication services, consumer discretionary. But that's good. When those conditions break down, there's a signal for a shift. And clearly, demand is now no longer rising, it's falling, and supply is increasing. We've gone from divergent to convergence. Well, that's probably a signal that things will change. You can look at the momentum portfolio. How many are in it? And what are the trend lines look like in it? Is it, is the stuff just getting to 10 with steep divergence between demand and supply, or is it none? We dropped dramatically to 11. Context, very important. And when I say context, what I mean, for anybody new, is what's going on in the cadence and calendar of the market. So if we go out here and look at, type the wrong thing. There we are. So if you go out here and look at the resources and the expirations calendar, I just think it's very important to know what's happening there. And here's what happened on this. Of course, this is designed for public companies, but it's very helpful to know that
Hey, Tim,
yes.
we're not seeing your screen.
Oh, you're not?
No.
Okay, so just to get back to this point, here's the expirations calendar, right? So this is under resources, hit expirations calendar, and May 31st. These month ends, it's not like every time it's going to have some great magnitude, but it is important to know when you get to month end, trillions of dollars of futures contracts get squared, and by that I mean that index funds, hedge funds, people who set hedges. Sorry, you're going to see these on this particular machine. That's what my life is like. Endless streams of email. I have to use 30 different auto sorts to keep up with it, and then I can go look at those folders and prioritize. But so when those contracts expire, there are parties to them. So if Goldman Sachs sold a basket of futures contracts to BlackRock so that BlackRock can appropriately track the weighting of an index, then Goldman Sachs will either make money on that transaction or not, and vice versa. BlackRock's going to pay a fee. Goldman Sachs is going to provide the service. They are in the risk transfer business, they say. And so that stuff gets trued up. And if there have been big moves, it may mean that they lose money and have to sell stuff. So it's just important to know that's going to happen, and it creates a little additional risk. I think it's the core reason that the market was way up on the 30th and then troublesome yesterday. And so going into it, this will lead into this second point here pretty soon about when can you chase prices and when shouldn't you? But that's important to know. It could be a bad time to chase prices, right? By which I mean if a stock has 4% volatility and it's up 1%, should you buy it, or do you wait for it to pull back? There are conditions where you can buy those, so we'll talk about that. That's point number 4 coming up. But that's important to know. Context matters. If a shift is going to occur, it tends to occur at options expirations mid-month or at month end. Here in May, 17th, 18th, 19th, that's when supply and demand diverged. It was a great, tech boomed. Tech boomed right through it, but that's very important. And so beware of those. If you're new, your veterans know this already, but you want to know if something's going to change, there's a higher mathematical probability that it occurs there than at any other time, month end and options expirations mid-month. Why those and why not every day if there are all kinds of instruments expiring? Because these have actual assets, committed longer-term assets associated with them. And so there has to necessarily be chairs that get shuffled. A 0 days to expiration instrument can introduce volatility, but not a trend. It doesn't have a consequence for a counterparty per se in most cases because nothing settles. It has no days. There's 0 days to settlement, right? Anything that settles has an ownership consequence, and those monthlies are much, much larger. So, and then let's go back to the dashboard. That's broad sentiment, the context. Look at the components of the momentum portfolio. Look at the trend lines across your dashboard. I'll go to tech or even communication services. So it's communication services mid-month, right at options expirations. We see demand was changing direction and supply was falling. What's likely to happen? Well, a pretty good chance those stocks are going to rise. Big tech had strong demand, high supply, right to options expirations in May. And then it fell off the cliff. But this now, demand is still very strong, well over 5, but it's starting to tail off. And supply, while very low, isn't diverging. Once the divergence breaks down, the gains shrink dramatically. It's just it doesn't mean that you have to leave them, but it means, okay, now you think about those as longer term holdings, right? And if they deteriorate below 5, you should be out of them because they're going to be a drag on your performance. And that's what we'll look for. Is that going to happen again? I don't know. We'll see how it goes. We know a shift is occurring. What we don't know yet is which direction it's going to go. Going down to tech, very easy to see this. You just look at tech and say, booming demand, right? It was already starting, but it crossed over 5 right into options expirations in May. Supply plunging. This is very likely to juice the group, right? And then particular pockets, we could go up to momentum to look for the best ones, right? And this is where we were finding all kinds of great tech trades. I mean, NVIDIA, Okta, Rambus, you could rattle them all off. And by the way, those are starting to change. If you look at Rambus has been just terrific. I came back from Greece and looked at this. I didn't buy it. I didn't have my, I wasn't ready yet. I didn't have my legs under me. But I look at that and you're like, wow, that's probably going to jump, right? If you have plunging supply and extreme demand, which direction is price likely to go? Well, all other things being equal, ceteris paribus, as the lawyers like to say, the stock's going to rise. And once that changes, then the opportunity that for gains greatly diminishes. And look at this. It's not that there's any problem with the supply side in Rambus, but it's not diverging anymore. I mean, the math is still going to pick it up because the day-over-day change was minute and continuing to decline. But if you're 10 out of 10 and supply no longer is falling, probably you want to take gains. And especially if it ticks up. Like if you look at Okta reported results, how would you, number one, I don't like to be in stocks around earnings. Witness Crocs, the Crocs disaster. I mean, that had good supply demand balance, but you never know. And you can look at Okta has been just a great stock, but if they're reporting results and supply rises and you no longer have a divergence, the probability of additional gains shrinks. It doesn't mean they're not there, but it gets much more challenging. You say, but Tim, there's a huge deficit. I agree. There is a big deficit, but there's nothing now driving price. So if any behavior stops, it could drop. And so that it's just important to know that going into earnings. You look at PSTG. Again, I could look at this data and say, well, based on the divergence, my good friend Paul Zayat's is the head of IR at Pure Storage. I've known him for 20 years, since he was the IR guy at Sun Microsystems. Terrific guy, very smart fellow. And I could look at it, and I sent a note to Paul. I said, probably there's a very, very high chance probability, we have models for public companies, that the stock goes to 35. Well, you can see where it's trading today. It's trading at 35. And that's because very strong demand, falling supply. But would I be in this stock into earnings? Probably not.
The name of the builder.
So,
Okay.
and I'll ask again, guys, make sure you're muted, because otherwise we'll be participants in your conversations. I want to go over here to just have a quick look.
Okay, go ahead.
Okay, the address is 2680 North First Street.
Admit. Let's see.
San Jose.
Yes.
Hang on, bear with me, guys. I'm gonna just I may have to mute you.
Okay. Who's the customer?
Hey Barry, that's you. You might want to mute yourself. Okay, so now where was I?
Company that was hopefully do the work.
Just making sure we don't have any questions here.
Hold on a sec.
Hold on, Barry. I'm gonna mute you. Hope you don't mind.
Art.
There we go. Okay. So back to that's the how do you know an individual stocks when things change? That's this. In individual stocks, if either side of the supply demand equation breaks down, you have to leave. And I realize this is, I'm not talking about the Hicks rule where you have a one-day divergence, you take your 2%. It's a fabulous, almost flawless way to make money. What if you don't have that kind of time, right? How would you, if you wanted to stay in Pure Storage as demand rises and supply falls, at what point do you leave? Well, you could say, well, mathematically, it's fine. The trend in the supply side is not great. It's almost to 50% again here, but the risk in context is earnings. You don't know what will happen. You could say the math suggests the price will rise. Yes, but there's greater risk there. Let's go look at NVIDIA. This is, another key specific point. How do you know when to go? Well, once again, I'd look at this and say there's absolutely nothing wrong with NVIDIA. Look at this enormous supply deficit, but it's no longer diverging. So if you were trading, you go find something else. Doesn't mean you have to take, it could be a long-term holding. Look at this beautiful chart for NVIDIA. It's been above 5 since January 10th. It's still there. So you could say the probability that NVIDIA continues to deliver gains is very, very high. When those conditions change, and if you back up a year, you can see where did the conditions change. Well, when it's no longer above 5, boy, you don't want to be in it. Or if the supply is well above trend, right?
Phillips Builders, that's the name of his company.
Yeah, that's my boy. That's Daniel.
Yeah.
Okay, so.
Well, my son's
Toby,
boy,
you're
that's
fucking
my-
lazy.
Okay, who's not muted? Can you guys just check, make sure you're muted, because that'll help. Thank you. All right, now back to my outline here. So we've talked about how do you know a trend change is coming? There you go. How do you know in individual stocks? If either side breaks down, if there's no longer a divergence, you're unlikely to continue to deliver the gains that divergences do, right? That's the key takeaway. Now, what if you don't want to trade short term? That, again, Edge is designed for short term trading, but it's also a great tool for keeping your stocks, your long-term portfolio, if you manage your own stocks, weighted toward things that are very likely to outperform. You could do that very simply. I think I did this last time too, but let's just take tech. What if you just want a sampling of tech, right? They used to say tech, we want the sector to be equal to tech, and we want to find stocks that are spending a lot of time at 5. This is a 30-day read, but it's a great way to think about it. So let's say we want stocks that in the last 30 days spend at least 10 days or more at 5, which means they tend to mean revert. So if the money is in that sector, mean reverting stocks will do well. If money's leaving the sector, mean reverting stocks won't do well. And you'll know when when stocks in a sector begin not to spend more time over 5, then you'll know. Let's say that we want the short volume trend, 30-day trend, to be equal to down. There's a much higher probability that stocks outperform if the supply side is trending down. We want to make sure that the supply is less or equal to 50%. It's not an absolute, and there are always exceptions to the rule, but that's a pretty good way to think about it. And maybe just filter for that. So that probably gives us 25 stocks. And then what you could do is you keep it weighted to stuff that is above 5. So, and we could do it by market cap too. Make sure that you've got large caps primarily, and supply that is above 5. So, for instance, you take Motorola out because it's a 3.4 and replace it. Take out Teledyne. Teledyne's kind of small anyway, but that's a 20 billion in market cap. Anything that falls below 5, you remove, and you just keep your portfolio weighted to things with a downtrend in supply and at least 5.0 on a demand scale. And that's probably, wherever the money is, likely to give you excellent performance overall. It has to be where the money is. It's just a way to think about it. It's not perfect. I think I've mentioned this before. I've got an engineer working on a utility that we can input various criteria to and run performance data. How's it done over 5-day, 1 month, 3 month, 1 year, 3 year basis? And it's complex, but we're making progress on that. And if it works, I'll share that stuff with you. I don't know how it's going to go, but we know statistically these data work pretty well. Okay, so then when do you chase and when don't you? What by this I mean, for those who may not be longtime edge users, let me just reiterate or recapitulate the way to think about volatility as a component for entries and exits. And you guys are good at this, but I would take just as an example, Sienna has volatility of 3.6%. Well, if it's, when the ideal is, well, it would be nice to buy it if it's down 3%, right? Because there's a very high probability that in the next number of days, you're going to produce at least a 3% return if it just mean reverts. So that's ideal, but it doesn't always work that way, right? I bought AMD because it was down 5%. It's already out of the momentum portfolio, but it was good enough. I was like, well, that's pretty good. And there's a high probability that new month, new money gives these stocks a boost. It's not an absolute, but it's a pretty good bet. That's a way to use it. But what about the times when these stocks don't decline, right? And how do you know that you can chase them? Some of you probably can answer this better than I can, but I can sure illustrate it for you. If the momentum portfolio has tech stocks in it and the broad market sentiment is rising and supply is falling, and you go look at the sector and the sector has the same trends, rising demand, falling supply, I might buy something that's up that has intraday. I don't like to buy, if something moves 4%, I don't want to buy it when it's up 3.9%. It's probably too late. But if the stock moves 4% on average, and it's up 1%, I'll chase that under those conditions because there continues to be a high probability that it rises. It's contingent upon whether money is coming in or not. And the way that we know whether it is or not is right there in front of us. We can see it, right? Money is no longer coming into tech. Now it might change. Might be that money looks around and says, well, there's no better place to be than tech, and it returns. And supply falls and demand continues to stay strong. But the probability is something else, right? The probability that tech continues to deliver what it did in May is very low looking at that data. So now the question is, where does it go? And I don't know the answer to that, but it is the last thing to talk about, which is what's ahead. And then I want to get to your questions here. So my last thing is, if we're looking at what's ahead, What's money going to do now? I don't know. We would have thought that value would be appealing. It just hasn't been. There are great selections in this portfolio. I would again say pick the ones that have a downtrend in supply over the ones that have an uptrend, all other things being equal. But clearly value has not delivered returns. Will it? I don't know the answer to that. So we're just going to have to look at what the data tell us. I don't try to predict what it will do. I just look at it and then know that it will predict what's going to happen. And so we'll have to see. So I want to pause there and what do you guys think? What do you think's coming? And I'll check to see if I've got questions. Is it possible for Edge to have earnings on the chart? Theoretically, yes. Theoretically, yes. It's a lot of data to manage, and it's not always accurate. There's that's the hard part. We would have to feed that data in, and obviously we could. So I'll consider it. I could put that on the development list. One of the things that we've got on the development list right now is to be able to look back. I missed that feature where you could go into a portfolio and look back and say, what was in it 2 weeks ago? I also want to have exits. If you could have like, here's your entry basket, what's your exit basket? That'd be really helpful too. But I'll think about that, Tim. Okay, what do you guys think's coming? What do you think, Tim? You're Steve. Yeah, Steve, go for it. I see your hands up.
Yeah, I was wanting to find out what your thoughts were on Biden's agreement to freeze the budget for 2 years and what kind of impact that would have on basically on our Federal Reserve being able to complete all the repo buying that they've been doing.
Yeah, it's a very good question, and there will be a huge backlog of funding that's necessary. But we track that stuff over in the corporate side of the business. One of our team tracks that data and compiles a little macro commentary. But we track all of the auctions and the totals coming out. It's a great question. It's really interesting to see that from you go back to 2019 to present, U.S. population has grown about 2%, and the federal spending has grown 55%. And if we reverted to 2019 levels, we would have a balanced budget. I mean, it's just almost astonishing, right? Because we have a lot of revenue. Revenue is not the issue, but I don't know what will happen. Steve, what's your opinion?
I feel like you can't freeze. I mean, we've become so dependent on the supply coming out of the reserve that I don't know what's going to support the market. I mean, they have been supporting it for the last 3 years, and especially in the last 12 months. So you start knocking that off, plus Biden's $1 trillion objective of lowering that deficit.
Yep.
So I don't see any positive way that this can go up, even with machines doing all the trading.
I'm with you. And if you look at the Fed's ability to shrink its balance sheet is very limited. And if you so we've come down from, call it 9 trillion to 8.5 trillion on the Fed's balance sheet. But over that same time, RRPs, reverse repurchase agreements, repos, as you were talking about, have gone up from 1.6 trillion to 2.6 trillion. So there's really no decline. They're just doing short-term swaps with big banks. Yeah. So I don't know. It amazes me that it works as well as it does, because you would think, well, if the Fed is not a consumer of U.S. debt, then the cost of the debt could skyrocket. And if the Fed is not the consumer of mortgages, the mortgage market could dry up. we have this. It's I don't know. It's frightening if you think about it logically, and yet somehow it seems to work. You're muted, Steve. But
For how long?
right. But their doom has been predicted for a very long time, and it hasn't happened. I realize it's very much like the Ernest Hemingway quote from character in The Sun Also Rises, Mike, I think, who says, how does a man go broke? Slowly, then suddenly. So we've been going broke slowly for decades.
Yeah. I don't know. Yeah. It's interesting to watch.
It is. Agreed. Yeah. Let's see. I've covered what I've got to cover. Any observation? Yeah, Barry, you've got your hand up. Tim, you've got your hand up.
Tim, I've got to ask for you, is it possible to be able to update a portfolio sentiment and short volume like we can on individual stocks?
Portfolio update.
Yeah, so like when you first open up and you see all the portfolios,
yes,
all you can see is a 30-day window. You can't go beyond that.
I gotcha. That is actually in development. Yes.
Okay, sweet.
It is at the very top of the list, and Eden, our chief engineer, gave me an update last week saying he's working on that. It's
Great.
fairly complicated math because of the Azure Blazor structure and how you're sending information out to browsers, but we're working on it. We think it can be done. Because I agree. I think it would be very helpful to be able to look back further.
Sweet. And then I've got a stock that is define the data that's a good one to watch, sentiment and volume, and that's Snow. Snow has been up, and it actually exceeding its volatility limits, while the chart says that it's not going to be a happy camper going into next week.
Very interesting. Yeah. There are edge cases. There are outliers. It's
61% sentiment below 5. It'll be interesting to see how it does next week.
So what are you doing with it? You're shorting this, right?
I'm watching. I'm still watching it, but I'm maybe short it next week, but we'll see.
Yeah. There are exceptions. There, no question. There are very, very strong central tendencies, but every now and then something defies supply and demand. And how is that possible? Well, because liquidity is really, really thin. If you look at this in a portfolio, I don't know what it trades. It's a pretty, it's liquid as stocks go, but that means that a very small change can alter outcomes. Let me just go find it really quickly just for my own edification here. It trades 12,000. That's very good. $12,000 at a time. On the other hand, that also means that the price can change every $12,000. So that is, there's the Achilles heel of supply and demand. One little thing can change it. And look at the lead behavior, which, they're everywhere. Passive, fast trading dominate the market. They're 70+% of all trading volume, and fast trading has an investment horizon of a day or less. So if machines are trading things and they're not cash settling, the supply and demand balance can persist. It doesn't happen very often, but it can, no question. All right, what else? Tim.
Yeah, I have over the past, before you went to Greece and got your pink eye, you had done some structure or testing on a short portfolio or short analysis, and I'm wondering whether you'd given that any more thought, or whether you've done any more testing on, it would be the anti-Hicks rule, right?
Right. Yes, it would. Exactly. Yeah.
I've tried building a sort of a put option analysis. Works pretty well. But I'm just wondering if you have come up with any other factors or items that might go into that kind of analysis?
I have not, other than this. I run this 75% short portfolio just as a benchmark to see, is it rising or falling? And it's jumped. It was 100 components 2 days ago. Now it's 130. That's a 30% increase.
Can I jump in here? Just take the momentum portfolio, keep all of the liquidity factors the same, but change everything else 180 degrees, and you'll have a negative momentum. And it works pretty good to find stocks that you can short. And it also is a good indicator between low volatility and momentum as you see them shift. So I track all three. So I kind of get an extra filter when the market's getting a little bit extended, because you can see negative momentum rising and you can see low volatility rising, and momentum is going down.
There you go. And let's see. This is if you want a snapshot of the criteria, there they are. That's the momentum criteria. And it's not perfect. The math is a double-edged sword. It can do a great job of finding stuff, but it also will leave something out that is like, 1 basis point removed from your calculation, So
yesterday negative momentum for me had 13 components. Today it has 25.
There you go. Yeah, and so how would one think about that ahead of the jobs data? Well, one day is not a trend and it could be an outlier, but you would say that the central tendency, the probability, is the market may not do well in response to whatever the jobs number is. It could be a surprise negative jobs number, which you would think, well, that's a positive. I mean, the ADP data out today, 278,000 jobs, way better than anticipated. But will it be exactly within expected parameters? Probably, but I don't know. And will the market react favorably or unfavorably? I don't know. But if you see a sudden jump in the short side of the market, you'd say, well, there's a greater than 50% chance then that the market reacts negatively to it. So I might try to be out of my, positions ahead of it. I don't know. I'm not saying I will. It'll depend on what the math looks like. But, you got a half a day to be out, basically. Well, not even that now. It's less than that, just almost the close. Okay, good. Well, I will, if there's, am I missing anybody? Any question? If not, we will call this good, and I hope to be back on camera next Thursday.